Welcome to the Deep Dive. Today, we are focusing entirely on the MasterBrand third quarter 2025 earnings call.
A call that dropped after hours on November 4th.
And if you were watching the tickers that evening, you saw a classic market panic.
Oh, absolutely.
MasterBrand gave us one of those fascinating contradictory narratives. A surprising revenue beat contrasted really sharply with a significant, and I mean disappointing, contraction in profitability.
There's a brutal reaction. I mean, when management is emphasizing disciplined execution, investors expect them to preserve margins.
Right.
Instead, the market immediately priced in some serious worry about the near-term path. The stock just cratered, more than 14% right out of the gate.
So our mission today is to break that down.
Exactly. We need to isolate the two main drivers of that disappointment. One, the sudden, pretty unforgiving dynamics of new trade tariffs, and two, how this all impacts their huge long-term strategic play.
The American Woodmark merger.
The merger, yeah.
Okay, let's unpack that immediate mixed bag of results. Let's start with the good news, the top line. MasterBrand clocked in at $698.9 million in net sales.
Which easily beat consensus.
Yeah.
By over $20 million.
Right. Despite being down 2.7% year over year, management was very quick to credit effective pricing and continued market share gains for that beat.
And that's pretty much where the good news stops. The profit story was a clear and frankly worrying miss. Non-GAAP adjusted EPS came in at 33 cents.
And the street was at 36?
Exactly. A 3-cent miss is meaningful, and the GAAP EPS was even starker, falling to 14 cents from 22 cents in the prior year.
But the real story, the thing that drove the stock collapse, was that margin squeeze. Gross margin fell 190 basis points. It landed at 31.2%. And for those counting at home, that is nearly 2 full percentage points shaved off their gross profitability.
And the adjusted EBITDA margin dropped 160 basis points to 13.0%, a severe compression.
So this is the central question of the deep dive for you. If they beat on revenue, why did that top line strength fail so completely to prevent the bottom line miss?
It boils down to two connected factors. Margin compression, for sure, but also, and this is critical, fixed cost deleverage.
Let's pause on that jargon for a second. What does fixed cost deleverage mean for a company like MasterBrand?
It's simple, but it's brutal for manufacturing. Their fixed costs, like the factory mortgages, utility contracts, they don't change much whether they produce 100 cabinets or 90.
Got it.
So when volumes are softer, meaning fewer cabinets are rolling through the factory, those fixed costs get spread across a smaller production base.
So each cabinet becomes more expensive to make.
Disproportionately expensive, yeah. And that inefficiency, compounded by these new trade dynamics, is what caused the bottom line to just crumble.
Okay, so shifting to the operational environment, management described demand as persistently challenging.
Yeah, consistent with their expectations, but certainly not getting any better. They estimated the overall market contraction was mid to high single digits.
But there was a real divergence in where those cabinets were going.
Yes, and this part highlights their operational strength. The builder channel, so new residential construction, it actually proved more resilient. It outperformed the broader market.
Why was that?
It wasn't just low prices. Management cited their product portfolio, sure, but more importantly, their service reliability.
Superior cycle time.
That's gold in new construction.
Yeah.
Have to hit your delivery deadlines. They appear to be winning share there based on execution.
Makes sense. Builders can't afford delays. But the repair and remodel side, the R&R, that was choppy.
Very choppy, especially in the lower-end stock cabinetry and the digital retail channels, which are super sensitive to consumer sentiment.
Right.
But the fascinating insight here is what they call the trade-down effect. Their mid-tier, semi-custom products actually delivered surprisingly strong performance.
So people still want to remodel, but they're looking for value because of affordability pressure.
Exactly.
Yeah.
Their multi-tiered portfolio is kind of acting like a strategic moat, catching consumers as they trade down from the most expensive options.
So even with soft volumes, they were executing their strategy. They reported that about 40% of the volume decline was mitigated by price realization.
Right, and another 20% was offset by market share gains, especially in that reliable new construction channel.
So they offset 60% of the headwind through active management.
And if you're assessing management's internal performance, that's a win in a tough environment.
But this is where the skeptical investor voice has to ask, if execution was that solid, why the big miss?
Because even great execution can't fight a massive, unexpected external shock.
Before we tackle that shock, let's quickly hit the balance sheet. They look financially healthy, right?
They do, though they missed one key leverage goal. Q3 free cash flow was about $40 million. Net debt is at about $839 million, which puts their leverage ratio at 2.5 times.
And they said they're well positioned to reduce that.
They are, which is important for the merger. But, and this is the key, they explicitly stated that the tariffs will prevent them from hitting their original sub 2.0x year-end target.
And that statement connects everything directly to the new trade policy.
And brings us right to the source of the market's anxiety. The tariffs.
This is the massive dynamic that drove the reaction. We're not talking about old policy, are we?
No, this is new. The Section 232 tariffs on lumber and wood products, they took effect on October 14th, so halfway through Q4.
What's really concerning, though, is the planned increase.
That's what investors are fixated on. These duties are scheduled to jump to 50% on kitchen cabinets and vanities in Q1 2026.
50%? That's not a slow burn. That's a policy bomb.
It's set to detonate in January.
So how exposed is MasterBrand, and how bad was the damage in Q3?
Their current estimate is that the unmitigated gross tariff exposure is 7% to 8% of their entire 2025 net sales.
Wow.
Now, they are domestically focused, which is good, but they still have product lines that rely on imports, and those are just getting hammered. Tariffs had nearly a 100 basis point negative impact on gross margin in Q3 alone.
And while they offset 90% of that Q3 hit, the Q4 forecast is where the lag becomes a crisis.
It is.
Give us the hard numbers. What are they warning about for Q4?
They are forecasting $20 million to $25 million in net unmitigated exposure.
Net unmitigated. So that's money that hits the bottom line.
Straight to the bottom line.
Yeah.
And just for context, their entire Q3 adjusted EBITDA was $90.6 million. We're talking about a headwind that could wipe out a quarter of their profit.
That is a staggering short-term risk, and they gave a perfect, tangible example of the disruption.
They did, and this detail is crucial. Management noted that nearly all of their bathroom vanities are imported from Mexico as finished goods.
Okay.
At a 50% price increase, they stated explicitly that this product category is not viable.
Not viable, so they just can't sell it profitably.
It can't be done under the new regime. That means they have to immediately cease or relocate production or just reevaluate the whole product line, and that risk isn't even fully priced into the current guidance.
Wow. If a core category is suddenly gone, that's an earthquake for the whole supply chain. What's their survival strategy?
They have a four-pronged plan, which makes sense. Targeted price increases, renegotiating with suppliers, alternative sourcing, and optimizing their manufacturing footprint.
Like the new Las Vegas facility.
Exactly, which they just got up and running. But here is the critical caveat, the part that creates the investor pain. Timing.
Right.
Mitigation takes time. Management said anywhere from 1 to 12 months. This is why they warned of a lag effect that will challenge margins for the next couple of quarters.
It's like taking a punch while you're waiting for your armor to arrive.
That's a perfect way to put it.
The short-term pain is clear, but they're playing a bigger game. The only way out of this kind of squeeze is scale, which brings us to their long-term growth story.
Consolidation, yeah. The Supreme integration is proving that their MasterBrand Way operating system works.
And the MasterBrand Way is basically their blueprint for integrating acquisitions efficiently.
It is. And that success is essential because the major prize is American Woodmark, AMWD.
So what's the latest on the AMWD merger?
It's full speed ahead. Shareholders from both companies gave their approvals on October 30th. The deal is still expected to close in early 2026.
And this isn't just about getting bigger.
No, it's about achieving competitive dominance precisely when tariffs are punishing smaller import-exposed players.
What kind of financial muscle does this combined company create? What are the synergy targets?
Management is highly confident they'll hit about $90 million in run rate cost synergies by the end of year 3.
$90 million. That's massive. That's nearly 30% of their current year EBITDA.
It's huge. And it comes from the textbook benefits of scale. More procurement power, cutting duplicate overhead, and optimizing that newly massive manufacturing network.
And financially, it's not leveraging them up too much either, is it?
Correct. Pro forma leverage at close is expected to be about 2.0x, which is right in line with their long-term goals. The sheer scale and the domestic footprint they gain from AMWD are absolutely vital here.
Okay, let's move to the guidance update for the full fiscal year 2025. This paints a difficult picture for the coming quarter.
It certainly does.
Yeah.
They expect annual net sales to be approximately flat year over year. That's organic sales down mid-single digits, with the Supreme acquisition providing a bump.
But the profitability revisions are key.
That's right. Adjusted EBITDA was revised down to a range of $315 million to $335 million. That's a compressed margin of 11.5% to 12.0%.
And the final bottom line damage report.
Adjusted EPS is now $1.01 to $1.13, and that lower midpoint directly reflects the immediate, unforgiving impact of those tariffs.
So they're taking actions to cut costs, but the tariff headwind is just too big to overcome in Q4.
It's too big and it's too fast acting. They're actively managing for a couple of difficult transitionary quarters.
Which brings us to the part of the show where we stress, at maximum volume, that the following discussion is purely for analytical purposes and is not financial advice.
Please always talk to a licensed professional.
With that necessary disclaimer out of the way,
Yeah.
this deep dive reveals a profound disconnect, doesn't it?
It really does. The market has absolutely fixated on the near-term pain, that $20 million headwind in Q4, but seems to be missing the massive long-term potential that these tariffs actually accelerate.
So what's the outrageous but plausible trade idea based on that discrepancy? If the market is focused on the short term, where's the overlooked value?
The thesis is simple. The real untapped value is in the accelerated domestic market share capture that will be forced by these tariffs, plus the highly actionable $90 million in synergies from the AMWD deal.
So the 50% cabinet tariff is basically an existential threat to their import-heavy competitors.
Exactly. And the market correction has effectively priced in all the pain, but none of the long-term competitive advantage this crisis hands to a company with superior domestic capacity.
Okay, so what would the trade look like?
You'd initiate a tactical bull call spread or maybe a long position, specifically targeting a stock price rebound after Q1 2026.
So after the initial shock.
Right. The core bet is that the 50% tariff will create such catastrophic disruption for others that MasterBrand's newly scaled domestic footprint will allow them to pass through costs and capture outsized share much faster than anyone currently expects.
They emerge from the trade war as a much stronger scaled entity.
Dramatically stronger.
And when does that thesis either prove out or fail? What's the catalyst we're watching for?
The target exit is after the Q4 2025 earnings call, which will be in February 2026.
Why then?
Because at that point, management will be forced to give a concrete, full-year 2026 outlook.
Oh.
And we expect that outlook will confirm the massive scale advantage and synergy trajectory as competitors are just struggling to adjust. That concrete guidance is the moment the market will be forced to re-rate the stock based on its future dominance, not its immediate shock.
That brings it all together. To recap, MasterBrand executed well on revenue and integration, but the sudden timing and severity of these new tariffs created a huge, immediate margin drag.
Which led directly to the severe market correction we just saw.
And that leaves us with one final thought.
Right. Ultimately, for you, the success of this entire scale play hinges on how fast management can pivot. Can they transform a tariff-induced cost pressure, the pain they are absolutely feeling right now, into a durable competitive moat for their consolidated domestic footprint?
That's the critical question.
And it will determine whether this stock is a value opportunity or a long-term trap.
An excellent provocative thought to end on. Thank you for joining us for this deep dive into the MasterBrand earnings call. We encourage you to continue exploring this knowledge on your own.